Stop scrolling. What you're about to hear is the kind of move that makes veteran traders go silent, makes headlines feel worthless, and makes everyday people ask the one question nobody on TV can answer. How did that just happen? Because last week, gold and silver didn't dip. They got hammered so hard the charts look like someone pulled the floor out from under the entire metals complex. And here's the wild part. While price was falling off a cliff, real-world demand for physical metal was heating up like a pressure cooker, with the lid welded shut. Now listen, quick chill guy check-in. If you're getting value from these breakdowns, hit subscribe, tap like, and drop a comment so I know you're here and the algorithm knows this community is real. All right, here's the setup, and then I'm going to show you the part almost nobody's talking about. We just lived through one of the nastiest singly shakeouts modern metals traders have seen. Silver printed a high that had people chest thumping, and then it unraveled so fast it felt like a trap door opened under the whole market. Gold followed right behind it, and for a brief window, it was the kind of selling that makes you wonder if a massive player got forced to smash the eject button. But here's the hook inside the hook. The selling pressure is only half the story. The other half is what happened on the ground. Coins, bars, inventories, spreads, and premiums. And when you connect those dots, the picture changes completely. So where do we go from here? Let's break it down step by step. And stay with me because the most important clue isn't the headline price. It's the message hiding behind the price action. First, the hard numbers on silver. We watched silver rip into the low 120s, then dump into the low 70s at the worst moment of the flush before snapping back into the mid-80s. That's not a normal pullback. That's a gut punch reset, one that wipes out leverage and rewires expectations. And markets don't behave the same after they do something violent like that. On the day of the worst hit, silver's dollar drop was one of the biggest single-day nominal falls people can remember in this era. Now, percentage-wise, it wasn't the worst of all time. The crown for percent pain still belongs to a historic episode decades ago when a heavily concentrated speculative frenzy finally got squeezed, margin rules tightened, and forced selling cascaded. That day, silver got cut in half. But here's the key difference. Back then, the dollar move looked smaller because the starting price was smaller, and that's exactly why this latest slide felt impossible to so many people. Now, let me address something that's been floating around. You've probably heard people call this a 10 sigma event, like some once-in-a-lifetime mathematical glitch. I get why that's catchy. It sounds like the system broke, but here's a more grounded way to read it. Because once you understand this, you stop being shocked by volatility and start reading it like a signal. Markets are not clean lab experiments. They don't follow neat bell curves when leverage, margin, and forced liquidation get involved. Real markets have fat tails. Big moves cluster. And when one big player or a chain of players gets hit with margin calls, the math changes because it stops being a normal market and turns into a liquidation machine. That doesn't mean it's fair. It means it's structural. And structural problems create headline moves. So instead of asking how could this happen, the smarter question is what had to be true for this to happen. And that question takes us straight to one of the most suspicious details of the entire sell-off: circuit breakers. A lot of people noticed that as metals were sliding, the normal breaks that should slow trading didn't seem to catch the move the way you'd expect. That triggered a wave of speculation. Was the exchange ignoring its own limits? Or did the market simply not hit the exact conditions that trigger a halt? Here's what's real. Futures markets can have daily price limits and different rules by product and by session. And those limits can shift depending on the contract and the day. Now, does that satisfy the emotional part? The why did it feel like there were no guardrails part? Not really. Because what people felt was this: when price rips upward, liquidity can vanish. And when price dumps, liquidity can vanish too. But on the way down, it often feels like the system is perfectly fine letting it fall because forced selling is orderly to the people who care about clearing. That's the uncomfortable truth. The market's plumbing is built to survive, not to protect your feelings. And I'm drilling into this for a reason. This exact dynamic is what separates paper price from physical reality. And we're going there next. But keep one thing in mind. Even after the beatdown, silver is still up, compared to where it started earlier in the cycle. That tells you something important. The long-term pressure didn't magically vanish. This may be a reset, not a funeral. Now, here's where it gets interesting. While the screen price was crashing, the physical market was sending the opposite message. Dealers described a surge of people trying to lock in metal, especially silver, because they saw the drop as a rare entry window before premiums expand again. Some mints and wholesalers were basically saying, "You're not ready for what's coming," describing demand that reminded them of the lockdown-era chaos. So, pause and ask this. If silver is collapsing, why are people trying to buy it like it's disappearing? That contradiction is the whole game. Paper moves instantly. Physical moves slowly. And when paper collapses faster than physical supply can respond, the gap shows up in one place: premiums and spreads. And there's another clue that screams even louder: regional pricing. Recent updates showed silver in Shanghai trading at a meaningful premium to Western benchmarks. And that premium widened as demand spiked. Let me translate that in plain English. If something is meaningfully cheaper in one part of the world and meaningfully more expensive somewhere else, that's not trivia. That's the market screaming that supply is tight, logistics are constrained, and local demand is paying up to secure metal now, not later. Now, do I want you to assume every premium is pure scarcity? No. Premiums can include taxes, import costs, shipping, financing, purity differences, and local frictions. But when a premium balloons and sticks, it still tells you one thing: real metal is not flowing effortlessly to meet demand. And this is where people mess up. They hear premium and think someone will arbitrage that away instantly. In theory, yes. In practice, arbitrage is limited by regulation, transport, time, and available inventory. And when markets are stressed, those constraints don't bend. They become walls. So if you hear silver is $40 higher over there, don't treat it like gossip. Treat it like a stress test result. Now, let's hit the big question. Is this sell-off a healthy correction or a warning shot? Here's my take. Straight and honest. A correction after a parabolic move is normal. It's almost required. Markets don't go straight up in a clean line unless there's some external control, and even then they eventually gap. The faster something rises, the more leverage piles in and the more fragile the move becomes. So, yes, this can be a reset, but there's a second possibility, and this one should keep you watching. The sell-off can also be a liquidity hunt. And when a market is hunted for liquidity, it doesn't stop at reasonable levels. It stops when enough forced sellers get wiped out and enough real buyers step in with size. That means the bottom isn't set by logic, it's set by pain. And that's why this matters. If what we just saw was a forced liquidation event, the rebound can be violent in the other direction once forced selling is finished. The people who panic sold become the people chasing later. So what do you watch now? You watch whether physical premiums expand. You watch whether delivery times stretch. You watch whether futures spreads behave weirdly. You watch whether the gap between regions narrows or widens. And you watch whether volatility stays elevated. Because sustained volatility tells you the market is still unstable. Here's another angle that explains why it felt like the market didn't make sense. Most people watch the spot chart and assume that's the market. But spot is a reflection of layers, futures positioning, options hedging, dealer inventory management, and sometimes pure mechanical selling when risk desks hit their limits. When volatility spikes, margin requirements can effectively rise even if official rules don't change because brokers tighten risk. Clearing firms demand more collateral, and anyone overextended suddenly needs cash fast. That's when you see the strangest behavior. Long-term holders don't want to sell, but leverage players don't get a vote. They dump the most liquid thing they own. And in metals, that often means futures. That's also why physical can scream tight while paper is dumping. Futures clear in seconds. Physical clears in trucks, vaults, and refinery schedules. Different speed, different rules. Here's the practical example. If you're trying to buy common retail products, one's rounds, small bars, government-minted coins, the supply chain has bottlenecks. Blanks have to be sourced, fabrication capacity is limited, and shipping has constraints. When everyone shows up at once, The first thing that happens isn't the world runs out of silver. The first thing that happens is the easy inventory gets snapped up and the premium rises to slow demand. That's why you can have a day where the screen price is down hard, yet your checkout cart is more expensive than it was last week. And it's not just retail. In stressed moments, tightness can show up behind the scenes. Lease rates can lift, spreads can get jumpy, and the market starts paying more for metal now versus metal later. You don't need to be a pro to understand what that implies. Urgency. Now zoom out, because this crash didn't happen in a vacuum. When big moves hit, exchanges and brokers respond in different ways. We even saw some markets put temporary limits on how wildly metal-rated exchange-traded products could swing in a single session after the breakdown, basically forcing a cooling-off period for retail flows while the underlying metal stayed chaotic. That tells you regulators and exchanges know volatility can become a confidence problem. And when confidence becomes the problem, the next move can get sharper either direction. So if you felt whiplash, you're not weak. You're watching a market go through a stress event. And here's the cliffhanger inside that. Stress events create the best information. They reveal where real demand is hiding and they expose which parts of the system are fragile. Now, I'm not here to tell you buy now or sell now. I'm here to show you the chessboard. And speaking of the chessboard, there's something bigger happening underneath gold and silver that most people aren't connecting. Industrial metals, copper. While everyone's staring at the precious metals drama, copper is sitting there like a coiled spring. And if copper decides to run, it changes the inflation conversation, the manufacturing conversation, and the entire hard asset conversation. Here's the big idea showing up across recently published numbers and industry studies. The world is trying to electrify everything, and copper is the wiring inside that future. Demand projections into the early 2040s are massive, with some forecasts pointing to annual demand rising from the high 20s million metric tons today to the low 40s by that horizon, alongside a supply gap that could leave a meaningful chunk of demand unmet without major new investment. That's not a small mismatch. That's structural. Now, to be clear, forecasts aren't guarantees. Demand can be delayed. Substitution can happen. Recessions can hit. Projects can get canceled. But here's why copper keeps returning to the center of the story. Even when growth slows, infrastructure build-out doesn't vanish. Data centers still get built. Grids still get upgraded. Defense systems still get modernized. Energy projects still move forward, sometimes slower, sometimes faster, but they don't disappear. And here's a fresh data point that matters. Major miners reported copper output pressure from declining grades and operational constraints, even as long-term demand expectations keep climbing. So, you've got a two-guff war. Supply growth is hard, demand growth is sticky, and price becomes the pressure valve. Now, bring that back to gold and silver. When liquidation hits, everything liquid can drop together at first. Gold, silver, copper, anything held with leverage. That's the sell what you can phase. But the rebound phase is where the truth shows itself. The rebound phase reveals what people actually want to own. And that's why physical demand matters so much. If the sell-off was paper-driven and physical stays tight, the screen price can snap back while premiums stay elevated, creating that weird feeling where people say, price dropped, but it's not actually cheaper to buy. Have you seen that before? It's confusing the first time, but it's a pattern. Now, I want to add one more layer of context because this is where the newer info gets real. Silver isn't just a shiny hoarding metal. It's also a critical industrial input. In recent years, industrial demand has been a huge slice of total usage, and the market has run deficits, meaning demand has exceeded supply multiple years in a row. That matters because deficits don't always show up instantly in price. They can be masked by inventories, recycling, and financial flows. But over time, sustained deficits tighten the system. And when the system is tight, it doesn't take much. One strong wave of retail buying, one supply hiccup, one surge in industrial demand for the whole market to feel like it's short metal. That's why people obsess over, is silver going to sell out? Now, let me be skeptical for a second. Sold out everywhere by tonight makes a viral quote. It's dramatic. It's also not always literally true, because there are layers of inventory, public, private, locked in different forms, priced so high nobody wants it, reserved for industry. So, instead of taking that claim at face value, here's the smarter interpretation. When people say sold out, they usually mean the popular products are gone, the backlog is growing, and premiums are rising. They mean the easy supply is gone. So don't get hypnotized by the drama. Watch the practical signs, product availability, wait times and premiums, and quick chill guy community moment. If you've navigated volatility like this before, drop what worked for you in the comments. Your experience might be exactly what someone else needs to hear. Now, back to price action because the next cliffhanger is right here. We saw the dump. We saw the bounce. Now the question is this bounce the start of a new leg up, or is it a dead cat bounce before another wave down? It depends on one thing, whether the market can stabilize without crushing demand. If silver stabilizes and demand stays hot, you get a base. If silver keeps whipping and premiums keep climbing, you get stress. And if you get stress, you can get another spike that shocks people who thought the story ended with the crash. That's the part I want you ready for because the market loves to punish certainty. Now, gold. Gold's drop wasn't as extreme as silver in percentage terms, but it was still a big move for a metal people treat, like the calm adult in the room. And when gold moves like that, it tells you liquidation was broad, not isolated. But gold has a different engine. Silver is part monetary, part industrial. Gold is primarily monetary and reserve-driven. So when gold gets hit, it's often about dollars, yields, and positioning. That's why when gold drops hard and then steadies, I watch currency dynamics and real rates. If the market starts pricing easier policy or weaker purchasing power, gold has a habit of reasserting itself. Now, I'm going to say something that'll annoy both sides. Bulls want every drop to be manipulation. Bears want every spike to be a bubble. Reality is messier. Yes, big players influence liquidity. Yes, derivatives amplify moves. Yes, narratives get pushed when it benefits someone. But markets are complex. The same move can have multiple causes. Liquidation plus profit-taking plus risk-off selling plus a stronger dollar intraday. That's why simplistic explanations fail. So what's the actionable insight? In high volatility, you can't just watch price. You have to watch the transmission mechanism. What's pushing price? What's pulling it? What's breaking? And right now, that transmission mechanism includes physical tightness signals and industrial demand signals. Now let's talk about what will matter this week. Psychology. After a crash, the crowd splits into three groups. Group 1 is traumatized. They swear off metals. Group 2 is euphoric. They call it the dip of the decade and go Allen. Group 3 is patient. They say, let the market show me. The people who survive long-term usually live in Group 3. So, if your heart rate is up, here's what I'd tell you as a friend. Slow down. Decide your time horizon. Decide what you actually own. Paper exposure or physical metal. Decide your goal. Trading, hedging, or long-term wealth defense. Because the same move means different things depending on the goal. Now, there's one more thread linking the metals crash to the bigger economy. Liquidity and confidence. When assets drop sharply, people search for what's stable. Some run to cash, some to bonds, some to metals, some to energy and resources. And the reason metals keep snapping back is because the backdrop is still unstable. Debt loads are high, fiscal deficits are persistent, and the appetite for real things doesn't vanish. It just rotates. That's why you can have a crash and a buying frenzy at the same time. Different players are doing different things. Now, quick note. Check the description for the bonus links. There's a premium WhatsApp channel link if you want quick updates. And there's also a channel membership join link if you want to support the work and unlock extra material. And for members, we drop members-only videos with deeper research and tighter detail stuff we can't always fit into these main videos without killing the pacing. All right, back to the part most people aren't talking about, the rebound. Silver bounced from the low 7s back into the mid-80s. That's huge. But rebounds like that can be a trap. Why? Because after a violent drop, the first bounce is often fueled by short covering and bargain hunters. It feels like relief. It makes people think danger past. Then the market tests the lows again. Sometimes it holds, sometimes it breaks. And that second test is where you learn whether the market is healthy or fragile. So this week, I'm not watching whether silver has a green day. I'm watching whether the market can absorb selling without collapsing again. If it can, you build a base. If it can't, you get a second wave that punishes anyone who bought too aggressively. So yes, the next few sessions could be educational. Now about that bigger trend, still intact claim. It can be true, but only under certain conditions. If fundamentals are tight, deficits, industrial demand, constrained mine supply, then yes, the long-term trend can remain constructive after a crash. But if the move was mostly speculative mania, a crash can kick off a long cooling-off period. So what drove this? In my view, both. You had real tightness signals and strong demand narratives, and you also had speculative heat and leverage. When leverage flushes, it doesn't mean the story is over. It means the story changes. And that leads to the next cliffhanger. Sometimes the flush sets up the next rally by removing weak hands. That's how bull markets work. They scare people out right before the next leg. Now pivot back to copper for a second because copper gives you a map for resource markets. Supply expansion is slow, expensive, and politically complicated. You can't just snap your fingers and open a mine. Permits take time. Capital takes time. Community support takes time. Infrastructure takes time. So when copper sells off with everything else, I don't assume the copper story is broken. I assume it's temporarily risk-off. Now, in the competitor script, there was a hard pivot into promoting a specific small company. We're not doing that. Instead, here's a framework for evaluating any resource company you see people pumping. 1. Is the asset real or just a story? 2. Is there a path to money, cash flow, financing, or a credible partner? 3. Is the valuation pricing perfection or pricing survival? If you can't answer those, you're not investing, you're hoping, and hope is not a strategy. Now, final stretch. Let's land this clearly. Here's what we know. We saw a violent sell-off. We saw a sharp rebound. We saw physical interest. We saw regional premium signaling stress. We saw the broader resource theme still alive, especially in copper demand forecasts. Here's what we don't know. We don't know if the market retests the lows. We don't know if more forced selling is hiding in the shadows. We don't know if the next catalyst is bullish or bearish. But we can prepare by watching the right signals. Signal 1. Premium behavior. If premiums rise while price falls, that's tightness. Signal 2. Delivery times. If delivery stretches, that's friction. Signal 3. Spreads. If structure tightens, that's metal. Now signal 4. Regional pricing. If Shanghai keeps paying up, that's concentrated demand. Signal 5. Broader risk appetite. If equities and credit wobble, forced selling can spill back into metals. Now, directly to the person feeling nervous. If you're holding metal and you just watched a huge drop, your brain is screaming to do something. That's normal. But the best decisions are made when you're calm, not when you're scared. Ask yourself, did your reason for owning metals change? If you own metals as a hedge against currency debasement and systemic risk, one ugly week doesn't erase that logic. If you own metals as a trade, then your rules matter. Stops, sizing, risk control, different goals, different actions. Now, second chill guy engagement moment. If you've navigated this well, share what worked for you in the comments. Seriously, somebody reading might need that push. And while you're down there, answer these 2 questions. Do you think this crash was mostly forced liquidation or the start of a longer unwind? And when you look at silver's overseas premium, do you see real scarcity or temporary friction that fades? Drop your answers. I read them, and they shape what I cover next. Now, let's close the loop with the most likely path forward, without pretending I have a crystal ball. Near term, volatility stays high. That's normal after a major shakeout. Medium term, the market either builds a base or retests the lows. Longer term, structural pressures, industrial demand, deficits, and the desire for hard assets still exist. That doesn't mean price goes straight up. It means the tug-of war continues, and the winner of that tug-of war is usually determined by the one thing nobody controls forever: purchasing power. Before I let you go, remember the description has the bonus links, the premium WhatsApp channel link, and the channel membership join link. If you want deeper dives, check the members-only videos. More research, tighter data, and extra context. One more thing about gold before we wrap. Gold tells you what big money is thinking, even when it's getting shoved around short-term. After drops like this, you'll hear bold targets tossed around 5,000, 6,000, and beyond. Targets can be useful as a compass, but they can also be bait. The real driver isn't a number on a thumbnail. It's the environment that makes those numbers plausible. Persistent deficits, heavy government borrowing, and the steady erosion of what a currency buys over time. If yields rise faster than inflation expectations, gold can struggle. If purchasing power keeps slipping while policy stays loose, gold tends to find footing. That's why I keep coming back to real rates and liquidity. It's not glamorous, but it's the engine. And here's a simple mental model. Gold is insurance. Silver is insurance and a raw material. When fear spikes, gold can lead. When growth and electrification dominate, silver and copper can sprint. That rotation is where a lot of people get chopped up. So, what's the plan for a normal person watching this circus? You don't need to predict the next tick. You need to avoid getting emotional. If you're building long-term, scale in over time instead of trying to nail the perfect bottom. If you're trading, respect volatility and size down, because the market can move farther than you think before breakfast. And here's the part nobody likes to admit. Sometimes the best move is to do nothing and just watch the signals. Let the market prove it's done clearing forced selling. Let the physical market prove whether tightness is real. Let the regional premium prove whether it's sticky or fading. Because if the premium stays hot while the screen price stabilizes, the next breakout can start without warning. And if the premium collapses while price chops, the excitement can bleed off for a while. Either way, the market will tip its hand. Your job is to stay calm enough to see it. All right, final cliffhanger. If silver holds this rebound while physical demand stays hot, the next move could surprise the people who got shaken out last week. But if the market is still clearing leverage and another wave of forced selling hits, the next drop could scare the crowd one more time before the real trend resumes. Either way, this week is going to reveal what kind of market we're really in. If you're still here, hit like so this reaches the people who need it. Subscribe, because the next update could land fast and you don't want to miss it. Thanks for watching. Take care of yourself. Take care of the people you love. And I'll see you in the next one. And one last thing, none of this is financial advice. I'm sharing my perspective for education and discussion. Make your own decisions based on your situation, your goals, and your risk tolerance.